welcome back to Wealth Dynasty. We're grateful to have you here again today. And today's episode, we are going to be talking about whole life, a little bit about the permanent insurance known as whole life insurance policies. And we're going to go into a couple aspects of this. We're not going to do an all-inclusive discovery or information about this type of product, but this is just some aspects in some ways that are overlooked that you can use this product to your advantage. So without further ado, guy here, Kurt Tucker.
Hey, how you doing? It's great to be here with you. So Whole Life is a wonderful product. It's not perfect. No product is. Whole Life has, in the insurance world, is guaranteed death benefit, guaranteed premium, guaranteed cash value. Those are the three basic elements of Whole Life. Now, Whole Life typically from the big mutual companies also pays a dividend. Dividends are not guaranteed, but are pretty steady for the most part. They vary a little bit from year to year, but they're fairly steady. And some companies have, well over 150 years of dividend paying experience.
Yeah.
All right. So dividends are what makes Whole Life really a useful, exciting product. But the guarantees are also important because, as you know, with term insurance, it's just a period of time. Any kind of universal life may or may not have a death benefit guarantee the entire period of time. But Whole Life has a guarantee the whole time. And so just a plain vanilla Whole Life with a major mutual company, it's going to develop a nice cash value. You have some options with it that you can use. If you want to boost the cash value quickly, you can do what's called paid up additions. You can purchase paid up additions. Why would you do that? Well, it's just like a savings account. And the thing about life insurance, you got to put money into it to get anything out of it. There's all kinds of cool things about like infinite banking, blah, blah, blah. But the truth is you have to put money in there.
Yeah.
Okay. It's not like it's going to disappear. A big magic, like shows up at my house. It doesn't happen that way. You got to put money into it, like the savings account. So Whole Life is like the savings account of life insurance. You put money in there, it grows. It's going to grow at a reasonable rate of return, a very fair rate of return. Typically, you're going to get a 3 to 6% rate of return in that cash value over time, but it doesn't have perfect liquidity all at once. So it takes a while to build the cash value. But once it's built up, and you can of course use it in a favorable way. Whole Life can be used to accumulate lots of wealth, and it also pays a very nice death benefit because the Whole Life, because of the dividend, typically the death benefit starts to grow over time. And so for a death benefit play, it's quite valuable because in the long run, it's got a very high death benefit relative to what you put into it. Whereas term has a high death benefit initially with little premium, but zero death benefit when you really need it most of the time. Most of the time, the term is dead 98% of the time. But Whole Life will have a big death benefit down the road. Plus a high cash value. So you can borrow against it. You can actually withdraw paid up additions if you want to. And there's all sorts of tax benefits, the tax benefits associated with whole life insurance, which is a income tax-free death benefit when properly owned, estate tax-free when properly owned, quick access to the funds. You can get your funds in typically a week to 10 days. So it's not a long wait to get the money. Stability, all these major mutual insurance companies are very strong financially. They have huge amounts of reserves and are able to pay their claims.
So that brings me to something that a lot of people don't know about with the whole life and other permanent life insurance policies, the products, I guess. What can a person do? Let's say I get old and I have a few $1 million already saved. I've already got everything paid for and taken care of. Can I just sell this life insurance policy, or can I get rid of it, or what would I do? Should I just cash it out, or what's my options at that point when I'm whether I need the money or not? Like maybe I do need it for medical expenses or whatever, or I just want to see what other options I have with this policy.
Yeah, so there is a robust secondary market for purchasing and selling life insurance policies. Typically, that's done when you're starting to show some signs of wear, if I may say it that way. Okay, the health may not be or your age is quite up there, or the health is not there completely.
So the more likely you are to croak, the more value you add to the.
That's exactly right. Okay, time value money.
Correct. Okay, or read the money faster.
That's right. Time value money. So,
and then companies are going to give you like a little nudge or anything.
well, that's always a fear. So it's an honest fear. Okay. Now that's never happened that I know of, but it's an honest fear. There was a while back in the early 2000s where there was huge amounts of this going on, where people would actually use their lives. They would be involved in a situation where they would be insured. They would actually get paid for being insured, and the insurance companies, not the insurance companies, but the policies would then be sold on an open market to as an investment. Okay, so life insurance can be an investment. Okay, and that went on for quite a while, but it didn't pan out because it turns out people live longer than expected.
Yeah.
And so the deal didn't work out as well as some people thought. But and that type of policy is really, that was a guaranteed universal life. It was used for those things. You really can't buy those anywhere. You can buy them still, but they're much more expensive than they were back then. So it's not as useful a tool. But a lot of people did that. I never got involved with that, but that was something that a lot of people did. But anyways, you can still, if you have a situation where you got a life insurance policy, you're getting older, you don't really need it anymore, the purpose of that policy may have changed completely, and you're comfortable with that being sold, then it's a perfectly legitimate thing to do. That can be done with any kind of policy, not just whole life. Whole life is very useful there. And the benefit to the insured is that you're going to get more than the cash value, less than the death benefit. Okay, and there could be some taxable gain there too, meaning that anything you receive over the cash value or the value of the policy itself may be subject to taxation. That's okay.
Yeah, that's very.
But it can be quite useful.
Yeah,
for the right situation.
Now, another thing that's often overlooked with the permanent policies is being able to gift the ownership to family or
it would just be a regular gift. In other words, it'd be like you can give away $18,000-$19,000 a year.
Yeah,
it'd be a gift. Okay. An individual can give $18,000 to $19,000 a year to an individual.
Yes.
Okay. But you can can gift the policy as well. And so sometimes you buy policies on the children. You want to make sure you gift it to them before the policy gets too big.
Sure. Yeah. Great.
But you can gift it. And let's talk about whole life for a second, a little bit. So lots of times in whole life, you can actually purchase a policy, which is kind of a hybrid. It'll be portion term, portion whole life. The dividends eventually get rid of the term portion, so it kind of grows. That's a little bit lower cost way, but you won't have the big death benefits down the road. It'll be a kind of more level death benefit. And there's all sorts of designs for whole life. You could have, pay to 100, and that's paid up policy. Pay to 65 is paid up policy. 10 pay, and there's all sorts of things in between.
10 pay is it you pay for 10 years, and then
it's guaranteed paid up.
Done.
Guaranteed paid up. And you do the same thing with a whole life to 100. You can put in purchase paid up additions, and you get to the point where it's paid up. Okay, 2 dividends and so forth. But whole life's a great tool. It's great. You just consider it like a savings account. It's solid. It's liquid. It's a great asset that can be used to as collateral for loans, for personal loans, or just borrow from the policy directly.
Take directly from the cash value as a loan, or use the entire thing as collateral for some other loan from Gap or a bank. Or
So one thing about life insurance loans on whole life tends to have a little bit higher interest rate against the cash value when you borrow from a policy than, say, universal life. So usually there's a little bit more of a differential between the borrowing rate and the dividend rate on whole life. So sometimes the distributions for whole life can fall apart because the loan rate may be higher and then it's too higher than what the dividend is earning, which is a little different than universal life. But it's a great contract, and also whole life or any kind of cash value in a life insurance policy can be converted to an annuity in the future, providing a guaranteed payment for life. So that's another thing you can use whole life, where you can gather the asset, and then when you need to, you can annuitize it, and it pays out the rest of your life.
awesome. So that's good. I think that's pretty much it. Yeah, that's all we got. So thanks again. Thanks for showing up, and we'll see you on the next episode.